Attendees are in listen-only mode.
Hello and welcome to today's Premier Account Market Update for June 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Knight, Managing Director of Investor Signals. I have 17 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving equities. We roll through the ASX top 50 with a particular focus on FY 16 earnings and FY 17 outlook. We look at the technical trends combined with the portfolio allocation and the short-term market outlook. The Investor Signals Premium Account Services, a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We focus on effective ownership around next dividend dates. It's all in a strict investment mandate, therefore suitable for superannuation funds, and importantly, the assets remain in your name. If you'd like to know more about the service, please contact me, Leon at investorsignals.com. Moving straight into the presentation tonight, the Dow Jones is trading on a forward PE of around 17 times earnings, supported by low global bond yields and reasonable earnings growth, and underpinned by very strong balance sheets. So we're continuing to see S&P 500 companies buy back shares at a rapid rate, which is helping to improve the earnings per share. And we all recognise that that's taking place in a backdrop of a fairly benign, low-growth global economy. And for that reason, we don't expect equity markets to materially move higher over the next 6 months or so. I think probably we finish the year roughly where we are. Obviously, there's a lot of volatility and concern in the air at the moment around Brexit, but I think either way that vote goes, we're in for a volatile period leading up to it, and obviously if it's favourable and Britain stays, then volatility probably quietens down on the other side. But I don't think it's a make or break issue for the global economy or for global equities, but we're certainly in for volatility, no discounting that. Interesting just to have a look at a barometer here. So the 30-year treasuries in the US, you'd normally expect to see this sort of closing on its lows if the bond market was really panicking that the Brexit's going to really derail global growth. But what the bond market was telling us last night with a strong rally off the lows is it's still probable that the US raises rates. Now, it would be unusual to see that happening in an environment where there's a lot of destabilisation. So we keep an eye on this as one of the indicators to help assist us whether we want to stay long equities or not. Gold has had a fairly good run here with higher highs, higher lows. I'm tending to sort of get the sense that probably gold rally may be coming to an end. But there's certainly some pretty bullish forecasts on it, but probably on balance, I think it's probably starting to sort of near the end of at least this run, and we'll look for a pullback and maybe a buying opportunity in the middle of the latter part of the year. Up on screen, the XFL, so the index of the top 50 stocks on the ASX. At the moment, lower lows, lower highs, and we expect that sort of type of pattern to continue. Therefore, there's limited buying opportunities in the market, and we need to be defensive and in the right assets. AGL is one of those right assets on a 3.5–4% dividend yield. Owning it, selling tight covered calls, you're getting 10% cash flow out of it, and I think it belongs in portfolios. Amcor, really back to where we started 18 months ago, or almost 2 years ago. The earnings growth the market was looking for, 8 to 10%, is just not going to happen. The company's had downgrades to earnings as a result of foreign exchange, one-off movements, and consolidation or closing of plant and relocation of plant activity, or the bottling and packaging and so on, their factory side of things. And that's had about something in the order of, I think, around sort of $300 million impact to their earnings, or $300 to $400 million, which is a substantial amount of money. So where we see this now is we put Amcor back on about a 4% dividend yield. We discount any forward earnings growth over the next 12 months, and I think the stock really goes back to trading around this $13.50 range. Therefore, we're buyers of it again, but only with complementing with the upcoming dividend and the covered call. Not being there in AMP, we think the structure's negative. We think the structure's still negative in all the Australian banks. APA looks interesting for us, but we're not adding it into portfolios. ASX, I suggest this goes on the radar. I think on this sell-off at the moment, it'll create a buying opportunity. almost 5% dividend yield, 5% earnings growth, and a little bit of defensive sort of counter-cyclical kind of earnings stream too. Obviously, when volatility picks up in the market, so does equity transactions, and I think that sort of makes the ASX a reasonably safe place to park money, especially in light of the technology investments that companies made and the positioning that they have over the next 1 to 2 years as a takeover target. AZJ, I think this is expensive. We're not looking for any further upside, and I think if anything, the pressure now comes to the downside in AZJ. BHP, lower lows, lower highs. Very hard to make a really compelling investment case for BHP. What we've done here, to the extent that we've owned it, we've sold covered calls and driving the extra cash flow, combining the dividend and the call option income. We're getting paid about 10% while we sit around and wait for a recovery. We really don't have much resource exposure outside of BHP. Brambles, I think this one comes onto the list. It's a buy on the dip, and I don't think we're too far away from that, so keep an eye on this over the next couple of days. If we don't hold it in portfolios, we're looking to add that. CBA, broad brush, all banks, lower lows, lower highs. I think probably CBA might be the safer bet. CBA and Westpac, I think the regionals look pretty terrible to me. But yeah, there will be a buying opportunity. I'm not of the view that the market just completely unravels and falls apart. So over the next week on this bit of panic selling, we very well may see a buying opportunity with the banks on 5.5% yield, and at least over the next 12 months, fairly defendable dividends. The concern for the banks is they're likely to all have to raise further capital, so which is going to weigh on their share prices. So we don't expect to see sort of a real return to high lows. Computershare, I think earnings risk coming up in August, pressure to the downside, lower lows, lower highs. To the extent that we own it, we've been very aggressive with the covered calls. CSL, this is a buy on the dip. Look for it to pull back anywhere from the 100 to 105 range, and it's a buying opportunity. We own it at lower levels at about $100, and we've gone out and sold covered calls around the 110 level. I think it should be a successful trade for us in the back half of this year. Caltex, we like this name, don't see too much in the way of upside. It's a little bit counter-cyclical too, and I think oil's hit its $50 sort of target or resistance there, and I think sort of we'll start to see a little bit more interest on money flow back into Caltex as oil prices pull back a little bit. And in saying that, I don't think it's enough to really make the share price accelerate. It's owning it here and selling tight covered calls, but it's defensive, and I don't see risks to the downside. GPT is our preferred property play. It's getting expensive, so don't go chasing it. To the extent that we own it at lower levels, we've been aggressive with the covered calls, paying about a 4.5% dividend yield. Maybe they grow earnings at 6% for these names. Most of the quality names in the market are looking expensive. This volatility that we're getting at the moment allows us to sort of pick new entry points in some of these quality names that are getting sold off at the moment. IAG, one of those names, I think that at $5.25 to around $5.40, maybe $5.50, within that range, I think we're getting reasonably close, maybe 1 to 2 days away from a consolidation IAG and an interesting buying opportunity. IPL not doing there at the moment. James Hardie is one of our preferred exposures at the moment. It gives us exposure to the fastest growing part, or one of the fastest growing part of the US economy, which is the housing market. James Hardie is expensive, but it's growing earnings about 15% per annum, and trades on just under a 3% dividend yield. But we own it at these levels, and we've been aggressive with the covered calls. We've collected the recent dividend, looking for it to trade up to around $22, $23 in the back half of this year, so we'll continue to revisit that one in the recordings over the coming months. Lendlease, as I mentioned, I think this could surprise on the upside in the August earnings season. The market's really concerned about Lendlease with their exposure to the Melbourne and Sydney apartment markets, but the underlying business, I think, is sort of recycling capital, doing sort of innovative things that are genuine to adding value to the shareholders. I don't see the risk of the downside all that great from the current price. The stock trades about 10 times earnings, which is pretty cheap on a 4.5% dividend yield. 10 times earnings is good value relative to other areas of the market at the moment, considering Lendlease may very well grow earnings at around 10%. And if they do that, we'll see a big jump in the share price there at Lendlease, so we continue to give that the benefit of the doubt. One of the few property stocks that we're actually interested in. Medibank Private, I like this name. It just got a little bit expensive, under 22 times earnings, now trading on just over 3% dividend yield. There's no doubt that the value buy range is around 275 to 290. Just not sure that we pull back that far, but if we do, the clients that don't have exposure to it will be wanting to add it into portfolios. Macquarie, I don't see it doing any better than what it has in the last 12 months. So at $2 billion of profit, company pays about a 5% dividend yield. The stock trades at about 12.5 times earnings. I think it's full value. So in an okay market that bumps along sideways here near the resistance, but I think there is some risks that are worth noting there to the downside in Macquarie. NAB, as with all the banks, the comments the same: lower lows, lower highs. We may get a technical bounce. It's worth keeping an eye on, but the risks there still to the banks around having to raise capital and not seeing that we're in an environment where they can really grow earnings or increase dividends. Newcrest has been obviously a great performer off the back of gold, but I think there'll be another opportunity for us to jump into Newcrest maybe around September, October this year, if we see the sort of pullback in gold prices that I'm anticipating that we'll see. Origin, we've seen to have a reasonable run. We've been aggressive with actual seller covered calls here. So whilst we've seen the company ratchet back the dividends through being aggressive with the call options, we're generating. We had the 550s that expired. Now we've got the 650s on. They'll probably expire too. So we're actually getting paid a reasonable amount of money while we wait around for a recovery in Origin. Orica, disappointed. They failed to even meet low earnings expectations. The companies had to reduce their dividend payout. There's not too much in the way of positive news around Orica at the moment. Oil Search, probably within the energy stocks within the top 50, it might be the most attractive, owning it here, selling covered calls, I think, is an interesting argument. Qantas has had a very aggressive sell-off, probably at the bottom of that at the moment, and not really on our radar as a stock for portfolios. QBE, we're seeing that pull back as the US yields have sort of tumbled a bit. I think QBE is a full value here, and we've been aggressive with the covered calls over QBE. Combination of the dividend and our call option income, we're earning around 10%. I think it largely sort of bumps sideways around these levels. Ramsay Healthcare, I think this is one of those stocks that are obviously trending in the right direction, and if we see a material pullback in the market and Ramsay ends up sort of back at this $64 to $66, probably worth having a look at. Rio, the story is the same here as BHP. Hard to sort of really get a fix on what sort of the earnings picture looks like. I think BHP may have better cost out announcements than Rio, and it might catch the market off guard a little. I think analysts have really sort of been preferring Rio over BHP. We'll just wait and see what happens in those August earnings. South 32 not doing anything there. SCG, I think this is sort of an okay defensive property stock. Really not much in the way of earnings growth. The stock trades about a 4.5% dividend yield. So if you want to sort of try to drive cash flow, owning it at these levels and being very aggressive with the covered calls and not allowing for much in the way of capital growth. But when you combine the dividend and the call option again, we're getting paid about 10% on a sideways move there in SCG. Seek, it's interesting, we saw in the news that Microsoft bought LinkedIn. I think maybe longer term that puts some risks around Seek, but over the next 1 to 2 years, I don't think we need to be too concerned with that. So we keep an eye on the technical trends here. We watch the upcoming earnings result in July, August. The company needs to reinforce and deliver on its results after a couple of patchy numbers over the last 6 months. But owning at these levels, selling covered calls, it's a stock that I feel more comfortable having money in than say some of the banks or regionals or areas of the market that are making lower lows and lower highs and under sort of structural pressure or structure from a technical perspective. Stocklands, I have to put my hand up and say I got this wrong. It looked like it was rolling over and heading lower. I thought there was the sentiment towards the housing stocks that would have weighed on Stocklands. I saw it maybe moving sideways at best. That hasn't happened. It's broken out and moved higher. It puts the stock now looking for about forward earnings of about 6-7%. But it puts the stock on about a 17 times earnings and about a 5% dividend yield. Maybe we take a look at it again if we see a material pullback, but it's probably got away from us a little bit at the moment. Sonic Healthcare, we like this name. We own it in portfolios from lower levels. I think at 20 times earnings, 3.5% dividend yield, the company should deliver about 5 to 8% earnings growth. A little bit expensive up here, but it's defensive. Even if we did buy it and then sell it at sell covered calls, I think that makes sense. Santos looks a bit expensive here and not doing it there at the moment. Suncorp, pressure to the downside. Sydney Airports and Transurban coming up to paying their dividends in a few days. I think this is a buy on the dip and look at a covered call to complement the upcoming dividend. The same with Transurban for clients that don't own Sydney and Transurban. I think on this sell-off, it actually produces a reasonable buying opportunity that's worth taking a closer look at. Telstra here, I think on this sell-off, I'm surprised to see a little bit of buying interest not sort of creep in today, so I'll keep an eye on this one closely tomorrow. But it very well may be worth sort of adding back into portfolios for clients that don't hold it at or near these price points. Westpac, as with all the sort of banks, the story is the same there. Wesfarmers, not much in the way of earnings growth, 5% dividend yield. It's got a reasonably bullish structure there, owning it and selling covered calls. Seems like an okay play to me on Wesfarmers. Westfield, one of the better property stocks, but on 3.5% dividend yield, it's expensive. We own it, sell the covered calls, collect the dividends, 10% cash flow, and it makes sense holding it. Woodside Petroleum, still the pressures to the downside, and as I said earlier, I think oil's peaked at sort of roughly $50 for the time being, so I don't know that the momentum's there to really push Woodside too much higher short term. And there we are back to the index. So my broad thinking is that whilst volatility is certainly in the air and the index could easily come back and test sort of this 4,800 level, I think more than likely what we're looking at is probably a 6-month period where the markets just really trade sideways. So, to me, it's an environment that owning the defensive assets that don't have too much downside risk, trying not to be overweight sort of the banks and resources where the structure is negative, but picking off sort of counter trend buying opportunities in those names when we see them, and being sort of aggressive with your derivative overlay across sort of the property trusts and the defensive names. I think that kind of rounds out the portfolio strategy at the moment. Thank you for listening in, and I look forward to speaking again next month.